love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning, Jim. Welcome to the show. What's going on? How can I help?
Well, I am 61 years old, 1 or 2 years away from retirement, and I'll be receiving a pension that will cover all my expenses, but I should not say more than about 3% of what I've saved for expenses. And I've read about and thought about the bucket approach. Right now I have like 70% in stocks and 30% in bonds. But if you have enough in bonds or fairly safe investments for 3 to 5 years, it doesn't really matter what your investment mix after that. And what kind of bonds would you suggest in a bonds mix?
Okay, so let me describe a little bit more to our listeners, Jim, what your bigger question here is. So first of all, to paint the picture here, you're 61 and you are arguably a pretty early retiree. So you're done working, correct?
1 to 2 more years working.
Well, only 1 to 2 more years. Okay.
Right.
And then when the pension are you already taking the pension?
No.
Okay, but so let's call it in 2 years, the pension fully kicks in, and then at some point you can also take Social Security. So
right.
And what you're saying is that that's enough income that in order to fill the gap, in order to fill that extra spending above the pension and Social Security, you only need to take about 3% a year of your investments, correct?
Or less,
or even less, which is a super low and I would say conservative withdrawal rate that you should be able to do in perpetuity. You can live 100 more years, Jim. And if you're only taking out 3%, you should be able to earn that just in income, quite frankly, every year and never have to touch your principal, which is exactly the position you want to be when you're in retirement. The question, though, I think what you're saying is that, okay, I only need to take 3%, but if I'm using the bucket approach, what are the percentages I need in each bucket? And as a quick reminder for those folks who don't know what that is, there are 4 buckets. Cash here they are: cash, income, growth, and alternative income. There's 4 main areas in the world that you can put money, liquid money, to invest. So this doesn't count your house. This doesn't count. This doesn't count the value of your business. These are liquid investments where you can put money to work inside your IRA. It can be in cash. It can be the income bucket, which are primarily various types of bonds or fixed income. Low risk, a little bit of income, non-market related, non-stock market related. You own bonds today for stability, protection, and a little bit of current income, a little bit of interest. The growth bucket is pretty complex because it's various stock-related investments. On the growth side, you can have companies that don't pay a dividend that you expect to appreciate, or my philosophy has to do more with dividend-paying companies. So think utilities, energy companies, older line technology companies that are more established that pay 2 and 3% dividends per year. So that's the growth bucket. That's the riskiest place we can have our money because stocks are a lot riskier than bonds typically. And then we have the alternative income bucket, this is where you put everything that isn't quite a stock or a bond. So think of REITs, real estate investment trusts, closed-end funds, MLPs, which are pipeline companies, preferred stocks. These are all these other areas that are super important for income investors, but they're not quite a traditional stock, not quite a traditional bond. That's the bucket approach. Question, though, from Jim is what's the percentage? And if you only need 3%, Jim, the ideal scenario that I like to see is the income that gets produced in combination from all those buckets. And let's just say for now, cash doesn't pay. Really, you can get about 1% in cash, but let's say 0 there. So just the 3 investment-oriented buckets, income, growth, and alternative income, I would say that to have 70% in the growth side and 30% of the bond side is fairly aggressive, and you're going to see some fluctuation because when markets finally do get back to normal volatility, we have a 10% correction, a 20% drawdown. when you have 70+% inside the growth bucket, you're going to see a big fluctuation in the value. That's okay as long as you're prepared for some volatility. The good news about the growth bucket is that if you focus on the dividend side of the ledger, then what you're owning inside of that growth bucket, the dividends themselves, along with, can be easily 2.5% all the way up to 4.5%. Some of these utility companies are well above 4% annual dividends per year on a percentage basis. So if you think of, and I don't want you to own all utility companies, because I think that you have to have more diversification from that, more diversification than just utilities, especially in a rising interest rate environment like we're going into. But if you look at if you look at it in combination, hey, what's my growth bucket doing? You want that kicking out 3% a year, and you want the bond bucket or the income bucket that has various bonds to be producing around 3% a year. So on that side of the ledger, Jim, 30%, in that 30%, I would keep those bonds relatively high quality, relatively short term. And that's going to mean that your interest rate, the interest you get from the bonds, it's not tremendous right now. Call it around 3%, 3.5%. That's floating rate bonds, which are a little bit more high yield, so there's a little bit lower on the credit spectrum. Floating rate bonds pay over 4% a year. So think about putting them as a combination together. You're getting 3.5% from the income bucket. You're getting close to 3% from the growth bucket, just in interest, just in dividends, just in cash flow. And in my opinion, even though 70% is kind of high for the growth bucket, 70% in stocks when you go into retirement, it's a little bit high. But if you only need that 3%, then you're never really worried about the fluctuation. At least that's how I see it. So I think that is okay. You had said, hey, I've got around 70% in the growth bucket. I think that that's fine. I think it's on the high side. I think that's about as much as you want to go into the growth bucket. It doesn't give you a tremendous buffer, but it's still balanced enough that it gives you a protection when markets fluctuate. So you want your income bucket to actually be stable, maybe actually go up a little bit in price while the growth bucket fluctuates a little bit. But the key here, Jim, is that the combination of those three main investment buckets, they're going to be kicking out just in cash flow as much or more than you need in order to fill the spending gap on top of your pension and on top of Social Security. And that is a strategy, my friend, that I think I like a lot. And I think it works. I've seen it work for decades, and there's no reason it shouldn't continue to work for decades to come. Jim from Lilburn, thank you for your call. Have a wonderful rest of your Sunday. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.